Good evening, ladies and gentlemen. Welcome to Triple N Talk Show. I am Dr. Nik Nikam. We are delighted you could join us, and we have a fantastic program this evening. We are going to be talking about real estate loan 101. We're going to tell you everything you need to know before you sign on the dotted line. Remember, you're signing your life away when you do these documents, especially real estate. Huh?
Sometimes
That's why I want to make
it seems
sure
like
that
this.
you know what you are signing. And before we go any further, I would like you to download our NNN Media app. So just go to Android or Apple devices. In their app section, you can download NNN Media. So you can follow us on any web-based or mobile devices. While we are talking about this program is being live video streamed through YouTube and also Google Plus. And when we are talking about YouTube, please do visit our YouTube. Our channel name is Nik Nikam, that is Nikam, and in our channel we have more than 700 videos accenting our experience here in the United States, especially Houston area. And we also have a Facebook page which is called the Nik Nikam Network, where we keep you abreast of everything that is happening in and around the Houston area and from around the world. And also, ladies and gentlemen, when you are visiting YouTube, please do make sure you subscribe to our channel so we can keep you posted as to what is coming up in the upcoming weeks. Okay, now we're going to talk about real estate loan 101, and my special guest is Frank Jreij. And Frank, welcome to Triple N Talk Show. I'm
Thank you.
delighted to have you, and hopefully I will learn a great deal about real estate loan because I'm in the process of looking for a house. Give us a little bit background about your professional.
Thank you, Dr. Nikam. First, I want to say welcome to all the audience that is listening to us. I appreciate the time with Dr. Nikam. We talked briefly before, and he thought that was a great idea to educate his audience about what we do in real estate and in mortgage financing. A brief about what I do. I'm a real estate broker, so we deal with residential and commercial real estate, as well as a mortgage advisor, so we finance real estate. And I think from both these experience together, you're going to have a lot of good answers today because it comes from both sides. It comes from reasoning about how do I get my financing together to buy real estate, and then when I have a house to buy, how do I look for a house and what do I need to keep in mind to get a good contract, and how do I fit the financing and the real estate contracts together to get a good transaction.
That's fascinating, Frank, because as I started listening to you, it looks to me like you get two for the price of one.
Exactly. I think
Because when you're dealing with real estate, then they say, okay, you have to go talk to the loan officer, and when the loan officer is dealing with you, they're not very much familiar with the whole real estate part. They say, okay, tell me what the price is and whether you qualify or not.
Exactly.
So you're like that. You have the whole global perspective of your clients.
Absolutely. Actually, very well said. That's what drove me into too. At the beginning, I started wanting to just be a mortgage loan officer, and a year later, I found out that I'm not doing my clients a lot of service if I don't understand enough on the real estate side. So I went and got my real estate license, and I'm talking now back in 2001 when I first got my mortgage license, and then a year later I got my real estate license. And after that, I was able to help my client on both sides because I can fit the contract very well with the financing that the client is looking for, and we can put a very good offer in front of the seller that is a win-win situation for my client as well as for the real estate transaction happening.
It looks like I got the right person to talk to. Okay, let's think about a hypothetical situation.
Okay.
I just graduated from UT a couple of years ago. I got a family, young family. We're just starting. We've been in an apartment for a couple of years. Now we're thinking about buying a house. Where do I start?
Great question, actually, to start with, because a lot of the people approach it that they go find a house and then they say, okay, what do I do now?
Yeah.
But the way you posed it, Dr. Nikam, is the exact way people need to think about it. Is before you even attempt to go and think about the house, you need to think, okay, where do I start? Well, where do you start is typically the consumer need to start lining up their financing. And before that, they need to know, what do I need to do to line up my finances? So for example, how much loan do you qualify for based on the income that you have now? How much property after that you can afford if they ask you to put 10% down payment or 20% down payment. If you know how much loan you will qualify, you will know how much value of the property. Only then you will be looking for that amount of property to buy, because you have the down payment, you're qualified for the mortgage up to a certain limit, and you can buy the loan. So
okay,
that's where you start at the beginning.
Okay, let's say I have saved some money for the down payment.
Yes.
How do I know what kind of loan do I qualify, or what price house I am able to buy?
Okay, so the process starts with applying for a mortgage. But before you apply for a mortgage, there's one thing we call, myself as a mortgage advisor, is we need to sit down and talk to you briefly. Just tell me, what are you trying to achieve? Because the story is a case-by-case basis between consumers. So for example, if you have been working for 2 years and you have your own business for 2 years, it's a different scenario than if you have been working for 2 years as employee with a W-2 employee. So when we sit together at the beginning, I'm going to ask certain question, and with your permission, let me just ask briefly the question so they know what are we getting to, and then we can go deeper into that. So are you employed or not? Are you a business employee or W-2 employee? How long you have been employed? That matters. And typically, lenders like to see at least 2 years employment. There are certain exceptions. We have something called doctor's loan, for example, where we can get loans for doctors right out of graduation, as long as they have a contract of employment with a hospital or with somebody. But the majority of the consumer will need to show at least a couple of years of employment, steady employment, or a business employment. But the cases are different, but they need to be working. So that is income. Then we need to see, how much assets do you have? If you're going to put down payment, where is that down payment coming from? Is it from your saving account where you saved it, or there is a possibility that you can get it from a family member as a gift, but there is a limit on those, how much they would allow you. Sometimes they would allow you up to $10,000 to have a gift, depending on how much asset and what is the income that you have. There are gifts allowed into the down payment. So we need to know where those assets are, whether you have checking account, saving account, how much is in each, whether you have maybe an IRA account that have some assets in it. And that money is what you're going to consider for down payment. Then we need to look at, obviously, credit. How did you handle your finances so far? And there is no right or wrong. Life gets in the way. People have certain credit issue. It's not a problem. It's just we need to know upfront so we can orient the loan package toward the right lender. Because frankly, our job at the beginning, when we sit to get this story from the consumer, I need to know the story so I can actually help you put a very good file in front of the lender so they can get the loan approved, because there are money from many different lenders. Every one of them have their own criteria and products to give us the money for that consumer. But we have to know what is the package that we are putting together so we know what lender is going to give us the money.
That's kind of surprise to me, because as a real estate agent, I thought you'd have say, okay, let's get in the car. Let me show you some nice houses which you might like.
Yes, unfortunately, that happens a lot for real estate people who don't know financing, because what's going to happen is it's going to waste their time a lot. if the consumer is not qualified for a certain line of amount of volume on the loan, I mean, then the consumer might say, okay, I want to go see a house $300,000, but if they're only qualified for a mortgage for 150, then what are they? Either are they going to put down payment 150,000, or they're not going to be able to get the loan, and then all the time that the realtor, maybe they were excited. Oh, I have a customer who
everybody's
want to
like
buy
that.
a 300,000.
Their colleague brought a house, their neighbors brought a house. So I want to get in the car and go and see some nice houses in the neighborhood.
Yes.
What's wrong with that?
Because at that time you will be very disappointed that you will look at 4 or 5 houses, you will find one that you really love, and your realtor tell you, oh, this is great, let's put a contract, and then he will help you put a contract, or she will help you put a contract, only to find out later that when you put the loan package together, you can't get the money to buy it, and then everybody will be disappointed.
So
this is why we start.
So you're using a whole
story.
new hybrid, new approach, I should say.
Absolutely.
So in other words, you're telling me I should just get loan qualified to see how much I really can afford and which I will be able to finance before I go and see the houses.
Absolutely, because
maybe you can expand on this one. First, walk us through, how do you determine how much loan I am able to get, and what kind of documents I need, and how clean my records need to be.
Perfect. I think this is the right time to talk about maybe a scenario.
Yeah.
So we were talking about what you need. When I sit with a consumer and I know their story, then I know how to package that file to get the right mortgage approval for them. Once they get the mortgage approval, then we know how much house they can afford, and then we can go look for houses, and I can show you houses that are fitting with that loan. So when you actually like the house, we know we can get the money and we close within 30 to 45 days, for example. So a quick scenario, for example, to answer your question, Dr. Nikam, is let's say you want to buy a house for $300,000.
Okay.
So the first thing I would say, okay, I put the loan application together. I need some information from you. It'll take us probably 10 minutes for me to fill up the application.
Yes.
And then in that application, I will ask, what is the income? Where is it coming from? What are the assets? The same question I was talking to about before. So from that, after we pull the credit of the consumer, we match something called debt to income ratio. So debt to income ratio is a ratio that the lender will always consider before giving you a loan. That will say, let's say you make $5,000 a month in income. The debt to income ratio, we have what we call front and back. The front ratio is how much house is your payment gonna be out of the 5,000.
So that's including the principal and the interest.
That's just the principal and the interest of the mortgage.
Or mortgage.
That needs to be less than 28% of your total income monthly.
I see.
Now, if you and your wife are actually working and you both want to apply on the loan, we can take the joint income of the husband and wife and make it total income, and then the house ratio become 28% of this total income.
Joint income.
Exactly. So realistically, if you have just to keep it simple, if we say 10,000 income, then 28% is going to be $2,800 total principal and interest. Now, there is a second ratio that the lender looks at that says debt to income. That means you take the 2,800 PI and you add to it the debt, monthly debt that shows up on your credit report. So for example, if you have a car payment of $500, you add it. If you have a credit card, you only add the minimum payment, not the balances.
I see,
So if your minimum payment on a credit card is $35, even if your balance is $5,000, it doesn't matter. It's $35 they're gonna add on it. I mean, I'm just giving an example. So for example, why? Because they know you are responsible only for the minimum payment.
I see.
So they can only add that. Now, most people pay more.
I know.
But the credit card company is asking for the minimum. And then you add any installment loan. So let's say you have, I don't know, you bought certain
Furniture
equipment or furniture
or a boat.
or a boat, and you have a monthly payment of so much, that also get added. So once you have that total,
Or even the
what we call
student loan
debt
and all this goes into that, right?
in the
If you have a student loan, we are paying monthly installment on that
yes,
one?
any monthly installment
Okay.
that show on the credit.
I see.
Okay, so let me say this, for example, if you have your brother loaned you $1,000 and you're paying him between you and him,
Yeah.
and it's not on your credit because you're probably going to pay it in 2 months, it's not on your credit, it doesn't show up, and it doesn't actually get counted because
Yeah.
it doesn't exist on the credit.
I see, yeah.
So what they do is they add anything on the credit
Yeah.
that is monthly, added to your PI, principal and interest, and the tax and insurance on the house. So you have a PITI plus the debts. Those have to be less than 41%
So
of your total income.
all credits, including the house payment,
Yes,
together.
yes, all
41%.
41% of the total income on
Yeah.
the application you're applying for.
So should we clean up some of the small credits before we, make an application?
So this was when we sit at the beginning, if
Yeah.
you what we were talking about, to see what is the story, what is the best way to put this file.
Yeah.
So when I look at the credit and I look at the total and I calculate this ratio, and let's say I find out that
Yeah.
your total ratio is 42%,
Yeah.
then automatically I'm telling you at that time that for us to put a good file together,
Yeah.
is there a way for you to pay this credit card or this
I see,
loan
yeah.
payment? And I can see it because on my system, when I take off this debt, what is the new ratio? So I calculate,
yeah.
recalculate the ratio, and I say, okay, this will work if we do this, if we
Yeah.
take this debt off. And sometimes you have enough money in the bank as an asset
Yeah.
to pay it off. So it makes sense to pay it off and get
Yeah.
the ratios in
Ratios
order,
done.
28% on the PITI and 41% on the total debt, including PITI. And at that time, the loan will be approved and we can get the right money
So
for it. The right
it
mortgage.
makes some sense to do some math and some clearing of small debts to get records in a
Only
better.
if you need it, of course.
Yeah, that's
Only
right,
if you need it. This is why what I'm saying is the original sit
Yeah.
down with me as a mortgage advisor is
Yeah.
important, because we orient the consumer the right way before
Yeah.
we even put a file. Because if you put the wrong file in the hand of the lender and
Yeah.
they reject it, then that's a wrong thing. That's a bad
That's
thing
true,
for
yeah.
the lender. They're not going to go and you can recorrect it, but it costs you money because every time you have to do another appraisal or
Oh.
another credit or something you have
Yeah.
to pull. So it's good to sit down and organize the file properly,
Yeah.
do the right math up front, and qualify by saying, okay, now I have this total income,
Yeah.
I have the right ratios, I have enough asset. We didn't talk a little bit about asset. Apart from having these two ratios,
Yeah.
you need to have reserve in the bank.
Yeah.
Typically the lender like to see 3-month reserve
I see.
on your PITI. So
Yeah.
for example, if your PITI, by the way, stand for principal interest, which is the mortgage if you want,
Yeah.
and then taxes, which is the property taxes that you pay
Yeah.
on the house, and the insurance, which is the hazard insurance to insure
For
the house.
Yeah.
So you add the monthly payment of the insurance, the
Yeah.
monthly payment of your property taxes, the monthly mortgage, which is the principal and interest, and that comes up to something we call PITI.
PITI.
PITI,
Okay.
principal, interest, taxes, and insurance.
Insurance. Yeah.
That number, the lender, when they give you the loan, they want to make sure you still have, when you close and you get the money buy the house,
Yeah.
you still have 3-month reserve of PITI. So
Yeah, I
three
see, yeah.
times PITI in your bank account. So if there is any difficulties a little bit later, at least you have some reserve.
Yeah.
You know, if you lose a little bit of income for some reason, you have some reserve
Some
before
buffer,
you
yeah.
start telling them, hey, I
Okay,
cannot pay.
let's take a little break. Ladies and gentlemen, we are talking about real estate loan 101, a crash course. You're going to learn everything you need to know before you sign your life away on the dotted line. And while we are talking about a real estate loan, we would also like you to download our app for Android or Apple devices. It is called NNN Media. This is exactly how the app looks on your smart devices. And you can also watch us on web. On YouTube. This is being live video streamed to YouTube and also Google Plus. When you visit YouTube, you can also watch more than 700 videos we have accenting our lives. And you can also visit our Facebook page, which is Nik Nikam Network, where we keep you abreast of what's happening in the Houston area and from around the globe. Yes, ladies and gentlemen, we are talking about Nik Nikam Network Talk Show, or Triple N Talk Show, and my special guest is Frank Jreij, and we are talking about Real Estate Loan 101, a crash course. Okay, now we talked about a hypothetical couple who have a $10,000 gross revenue, and you said $2,800 can go towards the principal and interest.
And
now tell us,
tax and insurance, PITI.
Okay, and tell us how big a house we can expect them to get, and how much is the down payment, and how do we make sure that we have a down payment before we go and see the first house?
Absolutely. So one of the things to calculate how much house is, obviously, we just started with 2,800 is the PITI because of the debt to income ratio. So you say, if my total income in the house is 10,000, I can afford 2,800 PITI monthly payment. That 2,800 represent the mortgage payment on a value of the loan. Now, the interest rate these days are about 3 to 4% on a 30 years mortgage.
Yeah.
We reverse calculate and say 2,800, we take off first the tax and insurance, because out of the 2,800, let's say there's 1,000 in tax and insurance, that leaves me 1,800 in PI, principal and interest. The 1,800 is the mortgage on how much loan. So we reverse calculate that and we get a certain number. So let's say we got 300,000 on a value of the loan. Well, no lender these days are giving you 100% money on the house. So you say 300,000 loan. If I have to put, let's say, 20% down, that means the value I can afford is 350,000, for example, or 360,000.
Okay.
Right. So basically, 300 is 80% of the total value. Actually, 375 is the exact number.
I see.
Because if you take the property value of 375,000 now, you take 20% of that, that's 75,000 down payment. That leaves you with a 300,000 loan. The payment on a 300,000 loan at, let's say, 3.5% comes up to about 1,800. So now
we are talking about a 30-year loan.
30 years loan. Yes.
Okay. Now let's back off a little bit. $75,000.
Yes.
I don't think I have $75,000. Maybe I may have like $55,000 or so.
Yes.
How do I make up for the $20,000? Can I just get the money from my brother or from my uncle?
Good question. So there are, once we get to the point where we know how much mortgage, right? So we said the PI, the principal interest, is 1,800. We reverse calculate that and we say the mortgage should be maximum 300,000 is what the lender is going to give you. From 300,000, we know already from the original application and from the sit down we had together that you only had 55,000 in the bank.
That's right.
So now we have two choices. We say, if we only want to use the 55,000 down payment, then you use that and you lower down the amount of the mortgage.
I see.
So let's say instead of borrowing all the maximum 300,000, you are approved for 300,000, but you can say, I want to borrow only 250 plus the 55, and that gives you your property
But Frank, I don't
value.
want to buy a smaller house. With all my friends buying all bigger houses and all this,
Yes.
like we are keeping up with the Jones who are trying to keep up with us. There's no way I'm going to buy a smaller house. Is there an alternative?
I understand. So I was saying this
I thought
was
you were on
one
my side.
option. This was one option.
Yeah.
So the other option is to say, okay, I have 300,000 in loan and I want to use that so I can maximize the property
Yeah.
value I can buy, and I only have 55,000. And now we go to the second option where the lender allows you actually to get a gift from a family member,
Yeah.
immediate family member, and that gift need to be with just a simple letter that says this is a gift, this is not to be returned, this is not a loan that I'm asking them to pay me back later. That's all the lender want to know, that this is something you can produce that say they gave me $20,000. Here is the letter that say this is a gift and I'm not wanting to return it, and they don't want it back. It's not a loan, because the moment you say it's a loan, that means you have a payment you have to add, and now your debt to income ratio changes because you have more debt. But if it's a gift, then they can give you 20,000 with your 55. Now you have enough 75,000, and you have enough for the down payment and you have enough for the loan.
That's a good point, because like it helps in even actually planning also. So you can't just jump up and say, okay, I saw this house, I want to buy this today, and then I'm ready to sign the paper. And if I don't have enough funds to even pay the down payment, so maybe if I'm looking at a shortfall on the down payment, maybe I should stop buying the boat I was going to buy or something like that, and that helps to talk to a loan officer before we go and look at the houses.
So here's where we come to our initial.
Yeah,
it's very important. I cannot re-emphasize more. It's very important that you contact me and we sit down, and it doesn't cost you anything. Our consultation is just to sit down with you, understand what you're trying to do, orient you the right way so we can have the best file for your mortgage. And at that initial setting, this is when we identify these different things. So if we see that, okay, you qualified for a 300,000, if we see the same scenario that you need 75,000 down payment and you're short because you have assets of only 55 down payment, then we can start exploring at that time. So where do you have 20,000 you can get? Anybody can give you a gift, anybody can. So we explore these situation and what works. And by the way, there's also a third option that says we were considering 20% down payment, but you can actually get loans these days with 10% down payment and some with 5% down payment. So we can use less of the 55,000. So just use 5% down payment, for example, but then the loan becomes 95%. And anytime the loan goes above 80% of the property value, then they're going to charge you something MI. It's called mortgage insurance. And that is an extra payment on top of PITI. So you have principal, interest, tax, and insurance, and this time plus MI. And MI is really to guarantee for the lender that they're letting you borrow 95% instead of 80. So that extra 15% makes the loan a bit riskier for the lender, and they make you pay for it.
Okay, this mortgage insurance you're talking about, how much does it cost, and is it going to stay for the entire duration of the loan? Because once I reach 80%, would it automatically go off my record?
No. So what happened is, if you borrow, let's say 5% down payment and you borrow 95%, then there is a mortgage insurance you're paying with the PITI. That mortgage insurance is calculated as 0.8% of the loan amount that you're borrowing. And that 0.8% obviously times the loan amount, it gives you a number, divide by 12. That becomes your extra that you pay every month while you are paying. So you got the loan, you got the property.
When you say 0.8%, to me that sounds like almost twice or thrice the actual interest we pay for the whole loan, isn't it?
No, it's the 0.8% is to calculate the amount of MI you pay per year, but your interest is still the same. You don't touch the, if your interest was 3.5%, your interest on the PI is still 3.5%. But what they say, so let's say your loan is 300,000.
Like if I borrowed $10,000,
yes,
you say 0.8%. That's almost like
that's less than 1%.
Yeah, like so how much does that come to?
It's
like $1,000.
It's $800.
$800.
Yeah.
For $1,000, $800 is like
no, for $10,000.
Yeah, for $10,000,
it's 800 per year.
Yeah.
You divide that by 12, and you're approximately what, close to $65 or something every month that you pay extra.
Okay.
So that MI, once you get in the property and you are paying every month, right, on your PITI plus MI, you are paying that. You're decreasing the mortgage because you're paying the principal down slowly. Once your principal become 80%, the mortgage principal become 80% of the property value, then you have the right to take off MI. But it does not go off automatically. If you don't do anything about it, it keeps going down and you still pay MI until it becomes 78% of the property value. At that time, it automatically drops off. So the way to do it at 80%, once your principal mortgage divided by property value is 80%, then you call the lender and you tell them, I have 80% now mortgage value versus property. They will ask you to produce an appraisal. So you will get an appraisal company, cost you about $400 to do an appraisal. You get the value of the house, and you and the lender know what is the principal that is left on the mortgage, and you divide these two. If it is 80% or lower, they will take off MI automatically. So you have to keep an eye on it while you're dropping your principal mortgage. Because let's say it takes 2 years to drop it, or 5 years. Well, if your property value is changing, hopefully going always up, and your mortgage, because you're paying it, it goes down. You have to keep an eye how that ratio is changing. Once it becomes at 80%, that's the time to actually
So if the property value is going down, it's not going to help.
Exactly. It's not going to help because it's going to delay you unless you pay more and more into the principal.
Yeah.
Exactly.
Ladies and gentlemen, we are talking about a real estate loan 101 crash course, and my special guest is Frank Jreij. Okay, let's give out your contact information and where your office is located, and your phone number if somebody wants to get in touch with you and get more information about what we are talking about today.
Absolutely. The name, I think you're going to see it on here, Frank Jreij. The phone number is 281-313-2422. Again, 281-313-2422. And my email is fjreij, like my first initial, FJREIJ, at newlandrealtytx.com. Newland, NEWLAND, Realty, REALTY, TX, like Texas.com. So fjreij at newlandrealtytx.com. And I'm sure Dr. Nikam will put my contact in the description in the video below as well.
Okay. Let's talk about now we have the loan approved and everything is ready. So we start looking at the houses. So then you wear your different hat.
Yes.
So walk us through, how do you determine, obviously, of course, we may select the area we want to be. Then what kind of research you do to show us the house that is in the range?
Absolutely. So once we had determined what type of mortgage you're going to qualify, how much down payment you're going to put, how much the amount of the mortgage, we know approximately the property value maximum that you can get to. So for our example, let's say it is $375,000.
Yes.
That means we're going to be looking up to $375,000. Now, there will be criteria at that time. As a realtor, I have to sit down and talk about what is your objective. So, for example,
Yeah.
Some clients want to be next to an elementary school because
see.
they have little kids. They want to be in a good school, certain area.
Yeah.
So that already determines a certain geography for us. Certain other client don't have elementary kids, but they have high school kids. So schools are
I see.
something we need to discuss.
A main driving force
is there. If there is no school requirements, then we talk to the next step is which area do you like? Do you want to be next to a golf course? Do you want to be next to a highway so you can get on the highway, go to work faster? Do you want to be next to the office? If your office is in a certain area of Sugarland, for example, or Houston, do you want to be close to the office, or does it really matter? So do you want to be in a enclosed area, gated community, or not? So these requirements as a realtor, I want to understand what are your objectives, and based on my obviously local knowledge of the areas, I can at that time orient you that within the price range that we are looking for, we can start looking at these properties that are within that criteria. And once we determine that, then we say, okay, what is available on the market now? And we look at them first. I give you whatever is available. You will get to see all the details of every property, and you can do it at home. You don't need to go anywhere. We can sit down together and show it on the computer, I can send you the file and you can just go through them. And then it'll have all the pictures of every house that we are going to show you, and the detail, how many bedroom, bathroom, the sizes of them, does it have a swimming pool or not, if you want a swimming pool or not. And those will be the options that are available for you to choose from.
That's interesting. So you actually can do like a virtual tour on the website before you even get on the road.
Exactly. So we give you a virtual tour, exactly that, and we show you different properties, and we can walk through it. So we can actually, while we're showing over the screen, we can talk over it. I mean, just like a Skype, for example, and I can, put my screen up on Skype, and while we're talking,
so they don't even need to be in your office.
They don't need to be in my office. So we just do it on distance. And believe it or not, we have done it with customer of us that were overseas, and we went on a Skype and I showed them the virtual tour. We were talking about the houses available after I understood what they wanted, which area, the price range and all. And then out of that, we talked over it. I answered the question about every house. And then they shortlist. They say, hey, we like number 2, number 4. We're going to be in Houston in a week.
See, they don't have a whole day to spend looking at 20 houses.
So all what happened is when they arrive, I would have the appointment ready. We go see just the houses they like, and then we go from there.
Since you're talking about Skype, I want to thank Google and YouTube for giving us this absolute technology, which is being used by our Indian Prime Minister and everybody else. And we have the same privilege to use this and live video stream this video that we are talking about to the entire world. And you may be able to use this one also, Google Hangout, and you can have up to 10 guests on, and then you can go to your web screen and show everything.
Absolutely. I think that is, we live in a very interesting time.
Fascinating.
Now
and I really thank Google and YouTube for giving us this privilege. Okay, let's say we have picked a house.
Yes.
But it's $400,000. I'm not convinced that the price is right. How do I know what is the most reasonable price for that? And how are you going to help me to get to that number?
Absolutely. So we worked together on identifying the right house. We did the virtual tour. You picked up 2, 3. We looked at those. Maybe there was other option that came on the market. We go also look at those. So now we identified it down to that one house that you want to make an offer on. So that is the right question to ask at that time. How much do I offer on that house? So my job as a realty broker is to look at that time and to advise you on what are the values that similar houses has sold around. So as a broker, I have access to every house that's sold in the market around that neighborhood, and then we start doing something called comparative market analysis. That means we look at similar houses, similar bedrooms.
Yes.
If it's a one-story house, we look at one-story comparables. If it's a two-story house, we look at two. If it's certain square footage, we look at similar square footage. If there is a pool, we look at houses with pool. So I accumulate what's sold in the area, and because ultimately it is not what the seller wants for the house, and it's not what you want to buy the house for, but it's what the market is paying for the house. So if there were 5 houses similar to this one, and they all sold for, let's say $150 a square foot, and this house is worth $300,000 or $350,000, let's say, to be close, then even if he's asking $375 or $400, we're not going to offer $400 because it's not worth $400.
That's right.
The market is saying, because of the comparative market analysis that we have done, and at that time I discussed this analysis with you as my client, and we go over it, and I show you why these houses are comparable to what you're buying, and I show you what is a good price to offer based on what we saw the market sold. And at that time, you will say, okay, here is the offer we're going to put. Now, my job is as an advisor, of course. So let's say my market analysis show you that this house is worth $375, not $400 that he's asking for. You might tell me, you know what? I like to offer him only $360. And it's okay. You can offer, but we have to be careful. If somebody is asking, if the house value is $375, he's asking $400. If you go to offer $300,000,
I know he's not.
People get insulted. The communication gets shut down, and you're not going to communicate. But you have to be reasonable. So one of the equation that goes into what I advise you at that time is say, how long this house has been on the market. So if the house is only been on the market for 1 week, well, rest assured, he's not going to go straight from 400 to 350. But if the house is on the market for 300 days and now he still wants 400, maybe there is more reason to negotiate now and say, look, it's not worth 400. It's been on the market for a lot. We are ready to buy it. We like the house, but we want to offer this. And
so you can use all this information when you talk to the seller.
Absolutely. So I coordinate with you as my client and my buyer, and then the seller has a broker that I'm talking to. So broker to broker, I explain to them, look, my client want to offer 350 because, look, these are the similar houses that sold in the market, and you're a broker. I know you probably know, but your seller is asking too much, and it's been on the market for a while, and we are ready to put a good offer. Let's negotiate on a good price that makes it win-win for him and us.
It also depends on the demand. If somebody from Europe or somewhere, they come and say, okay, I'm an executive for Google, and since we are using Google, we can say
yes, we can say Google. Actually, they will.
I've been hired, and I'm ready to write the check.
Yes, and that happens actually when a client likes a house. They are ready to overpay sometime to get the house because it's a supply and demand. If you have a great house as a seller and you put it on the market, and all the comparables are, well, maybe equal in square footage, maybe equal in, land area, but maybe you have a bit more upgrade, you took care of it very well, and there will be a buyer that walks into that house and he sees 2-3 other houses, and he comes and love your house, and before he loses it, he says, so how much you want? 400? Here is 400.
Here's the check.
Maybe not give you a cash, but he says, I don't care if my loan is only 300,000. I will pay the down payment instead of 75. I'll pay 100. So they might be willing to pay a little bit more over market price, even though my advice is the market price is 375. But if it's a unique house that they love, the buyer has the right to pay whatever they want.
That's right.
And if they like it and they don't want to lose it to somebody else who put another offer, it's okay at that time to say, okay, well, you can get this house, but that's what he wants for it.
Ladies and gentlemen, we are talking about a real estate loan 101 crash course. So hopefully you have learned a great deal. I have learned a great deal so far. And this is coming to you live on YouTube and Google Plus through NNN Media. And while we are talking about NNN Media, we would like you to download your app for Android or Apple devices so you can follow us around the clock. And when you visit our YouTube, which is Nik Nikam, Nikam, you can also browse through more than 700 videos we have accenting our lives here in the Houston area and also the Sugarland area. And my special guest is Frank Jreij. Jreij, right?
Jreij, yes.
Jreij. Okay. Let's say we agree on a price of $365,000.
Okay.
He says, yes, I'm ready to buy. Now I have been pre-qualified. How long does it take for me to get the keys?
Great. So now once they agree, the buyer signs the offer, the seller signs it at that time, and it becomes an executed contract.
Yeah.
And we put earnest money, the buyer puts earnest money on that to make it binding.
Yeah.
And we deposit it at the title company. So now the time clock starts, and we give the same executed contract to my mortgage. And
I see. Yeah.
at that time, we start doing the mortgage process. So we have a processor that works on the paperwork, and I work with the lender to get the right product basically executed now because we have a contract on a property.
Yeah.
It used to be that we were always able to close within 30 days.
I see.
You still can do 30 days, but there was new rules in the mortgage industry that came out beginning of October from the government.
I see.
And there are certain procedures that you have to go through it. And these are sometimes lengthy procedures.
Yeah.
And now it's always advisable after October to going forward, if you want, to put a contract for 45 days because
I see.
it'll take time to do disclosures back and forth to the buyer, to the borrower, basically disclosure between the title company at the end and the lender and appraisal in the middle. So there is a certain process we have to follow, and it's advisable. 30 days is going to be very, very tight.
Right.
So we write contracts for 45 days, and obviously we agree with the buyer and the seller so they know we are closing, let's say, 45 days from
I think 45 days may be a better option because, both husband and wife work and they have to go and shop for the curtains and appliances and all these decorative pieces and furniture. So, yeah, I mean, we had no furniture when we were staying in the apartment.
Absolutely. So now you have
because we
time
can
to
only
get
do
ready.
it a couple of hours on a weekend because, when I'm working, my spouse may be in the house, and when she's working, I may be, somewhere else
So,
or out of town.
During those, let's say, 30 days or
Yeah.
45 days, during the mortgage process, by the time we close, the steps are very simple. At the beginning, the contract is with the title company.
Yeah.
The title company researches the property to see if there are any old liens that are attached to the property about the seller. And if there are any liens, obviously they need to get the seller to clear them, or they will work with him to clear those liens, because the borrower, the new buyer of the house, need to have the house free and clear, well, not free from any liens, except his new mortgage that he's getting, which will be the new lien on the house.
What about this one more thing that is there an origination fee still nowadays?
Yes. So with the when you do a mortgage process for a borrower, the fees, the origination fees, is what pays for the mortgage officer to do the work.
I see. Yeah.
So there will be certain fees, not many, but there will be a underwriting fee to underwrite the loan from the lender side, not the mortgage broker. There will be a processing fee, which is the basically department that takes care of moving the paperwork, following up on all the income, the assets, everything that the borrower has to give the lender, it goes through the processing department to put the file together and to follow up with the title company, to follow up with the appraiser, to follow up with the inspector. So that is also a minimal fee. And then you have the origination fee, which actually pays for the mortgage broker to actually do the loan. The rest are title work. So that means the title company who is doing a title research on the property need to get paid. Typically, it's paid part from the seller, part from the buyer, because that property is now in the transaction and both parties need to pay.
So these are all put together called a closing cost.
Closing cost, exactly.
So I think more often they put the closing cost into the loan, or how does it work?
So if it's a purchase, that means you're buying the house and you're getting a loan to buy it, then you come to closing with the down payment plus the closing costs.
I see.
Now, remember our original sitting down. If we see that the buyer has not enough assets to pay for down payment plus closing costs, then when we write the real estate contract, and this is where us knowing financing and real estate come together, when we are writing the real estate contract, we actually, there is a clause in there that we can ask the seller to pay part of the closing cost up to about 2 or 3% even. So that means, let's say closing cost on the house is $6,000, then we can put in the real estate contract that we not only agree on the price we want to buy it from you, Mr. Seller, but we also agree on this price and we want you to contribute $6,000 toward the buyer closing cost.
That's a very important point. I never heard that one before.
Absolutely. And that saves money from the buyer. So they don't have to come up with closing costs at closing because they only have limited assets from what we discovered at the beginning.
See,
so we write
when we
the
started,
contract
we were
properly.
talking about 20% of the value of the house.
Exactly.
But most people don't even think about closing costs until they are ready to go to the title company for closing. Or the title company says, bring a check.
So if you can think that instead of 20%, there are options to bring maybe 5% and or 10% down payment. Now we limited the amount that the buyer is bringing to closing. And there are options where if we know the assets are also limited, we can also try to put some closing cost on the seller side in the contract so they pay for it. And obviously that will affect on the price they will agree for. They might say, okay, I will take 365 if I don't have to pay closing costs, but if I have to contribute to closing costs, I want 370. And that might be a good solution. Say, okay, I'll pay you 370.
30 years.
Exactly. I'll pay you 370 and you pay 5,000 or 6,000 toward my closing costs. That way I don't have to pay it now. And then if you think about it, if you pay 370 on a house versus 365, you put 5% or 10% down payment, the loan difference, what you pay every month is going to be probably $10, not even difference.
That makes a big difference.
So
for somebody
instead of
starting,
paying, exactly, instead of coming up with $6,000 at closing to pay closing cost, you might say, you know what, I'll pay him 370, let my loan be up another $10, and instead of 1,800, I'll pay 1,810 every month. And you're fine.
That's like a smaller dose of medicine.
Yes, and it's like, you know, you took a little bit more financing, but on a, remember, interest rate are at 3.5%, so you're not actually costing you too much.
Frank, it's been fascinating, and we got a couple of more minutes before we go. I have one more question I want to ask you. Ladies and gentlemen, you are watching this being live video stream to Google Plus and YouTube. Thanks to both Google and YouTube. While you are talking about YouTube, we would like you to download our app, which is NNN Media for Android or Apple devices. And when you're on YouTube, you can browse through more than 700 videos we have accenting our experience here in the Houston area. And please do subscribe subscribe to our YouTube channel. Okay, my special guest is Frank Jreij. Okay, let's give out your contact information and phone number and all this. And I have one final question.
So Frank Jreij, 281-313-2422. And the email is fjreij, FJREIJ, at newlandrealtytx.com. And obviously, you are welcome to call us or email us with any questions or scenarios so you can prepare better for thinking about buying a house. Or, by the way, all this information also apply when you are thinking of refinancing a house, because sometimes you have a lot of equity in your house, you want to cash out some of it. Sometimes you just want to change the rate and term on the mortgage that you had 5 years ago, because now interest rates are much lower, and we can do what we call a rate and term refinance, just change the rate on the same amount of mortgage you have now, and it'll lower your payment, and we can at that time include the closing cost inside the loan, so it doesn't cost you anything for you to do the refinance of that loan.
Okay, I got another question here. And, most people get paid bi-weekly.
Yes.
So does it make sense to pay your mortgage payments bi-weekly versus monthly? And, how much money we can save if you pay it every 2 weeks?
Okay, that is a nice question. One of the things about the mortgage, so let's say you have a 30 years mortgage that you just acquired. You just bought a property, you got 30 years mortgage to pay it off. At the beginning, if you look at your first statement that you get from the lender after you close and you got into the property, it's going to be mostly interest. The first payment, let's say your payment is $1,800 to stay with the same number, you're probably going to have $1,720 of interest and $80 of principal. So every month, your principal go up a little bit, less than $1 maybe. Your interest goes down less than $1, and it keep going this way. It'll take you almost 20 years to reach halfway point. And then obviously the last 10 years, you will be paying down the principal real quick. And at the 30-year mark, you would have paid everything. But because it's a compounded interest curve, the first 20 years are almost all the interest that the lender wants from the loan. It'll be like front-loaded on the first 20 years. Now, if you take that same 30 years mortgage and you pay one extra loan a year, so if your payment is $1,800 every month and you start today, you just walked into the property, during the next 12 months, you're going to pay every month $1,800. If you make one more payment, you make 13 payments during those 12 months, then, and you just do it every year like that. So you make 12, and on the last month, you make 2 payments instead of 1. And then the second 12 months, you do the same. If you keep doing that, you will finish the whole mortgage in 23 years. You will save 7 years
of payments.
If you make one more payment every month, every year. Or one more monthly
Nobody's
payment.
Nobody's going to tell us all these secrets, are they?
Exactly. So you can do it 2 ways. You can pay actually one extra $1,800, or like Dr. Nikam say, instead of paying $1,800, pay $900, which is half, every 2 weeks. So every time you get paid, if you get paid on a Friday every 2 weeks, every time you get your check on a Friday, pay $900. If you follow that equation, there is 52 weeks in a year. So you would have made 26 payment. 26 payment on, of 900 is 13 payment of 1,800.
That's right.
So you can make it, if you want to be, steady, just make it every 2 weeks if that's more comfortable, and pay 900 every 2 weeks. That comes up to one extra payment a month, one extra monthly payment a year. Or you just say, okay, every December I'm gonna make 2 payments, 1,800 plus 1,800. You can do it either way, but either way it will save you 7 years of that mortgage, and you will finish in 23.
Man, I wish I had known that, because I sat and calculated at the end of 30 years, actually, I had paid twice the amount of the house value in mortgage and interest.
Yes.
I mean, this is insane. If my house was worth 300,000, at the end of 30 years, if I went by paying just what they wanted me to pay each month, the total amount I paid was like 600,000 over 30 years.
Yes. And let me take it one step further.
Yeah.
What if you make 2 extra payment a year? So instead of 12 monthly payment a year, you give them 12 plus 2. So let's say every 6 months
you pay
you make another 1,800. 6 months later, you make another 1,800. You will finish that 30 years in 17 years.
Oh my gosh.
So
where were you 30 years ago when I bought the house?
We didn't have YouTube and Google to thank.
I think that's the most fascinating point, which I think every real estate owner should know, because you're telling you painted half the time, close to
half the time. So it's very simple. If you think about it, if you are a young couple, just bought their first house, and you're both working, you got the loan, you started in the house, your monthly payment is $1,800. If you can afford every 6 months to make one more monthly payment, so let's say if you have something saved on the side, instead of keeping more saved, if you can move 1,800 of that saving and pay one more, and pay one more every 6 months, and you can finish in 17 and a half years, I can calculate. Once you call me, we can sit down and I'll do the calculation exactly for your case, and I will show you the amortization schedule that shows you how much interest you would have saved. Just like Dr. Nikam said, if you had paid 30 years, you almost pay 2 or more sometime than your principal amount. But when you do the 23 years with 1 monthly payment extra, or 17 years with 2 monthly payment extra, you're saving at least a third of that interest that you would have paid.
Absolutely phenomenal. More. When I started paying in '84, my interest rate was 11 to 12%.
That is where the big saving were at that time.
Oh, that would have been like
absolutely.
See, I didn't know this. Frank, it's been a fascinating discussion. Thank you so much. Let's give out your contact information one more time. And I want to thank you very much for being on Triple N Talk Show.
Thank you. Again, Frank Jreij, 281-313-2422, 281-313-2422, fjreij@newlandrealtytx.com. It was a pleasure to address you today. I want to thank Dr. Nikam and the Triple N show that hosted me and allowed me to put this information out to your audience. As Dr. Nikam knows, I lived in Bombay actually for about 2.5 years. I used to work there for.
Now they call it Mumbai, but I still stick to Bombay because that's what it was when I left.
That's
India.
what they told us. They told us start calling it Mumbai, but everybody knows it at Bombay. So. So I'm hoping through the Hangout and the Google, some of my friends in, Mumbai are listening to us, whether live or not. We'll send them the link, obviously.
Yeah.
But I hope you had a lot of good information from this show. I know it's a short time for us to address everything, but this is why Dr. Nikam wanted me to put my phone number and email out to you. You are welcome to call or email with any question and any scenarios. And as I said, I'm a phone call away or email away. And if I can advise you properly right from the beginning, when you are even thinking about, well, do I need to buy a house, or can I buy a house, or how much house can I afford, or how much is my mortgage payment going to be, or can I refinance, or can I get some cash out of that? That is just part of the information that I can help you with. Then at least you are on the right track and you can make intelligent decisions and good decisions, and hopefully we will have a part in your success when you do it. By the way, this information also applies. Please call if you have an investment property, a rental property that you are thinking, hey, do I have too much equity sitting there doing nothing? Can I pull some of that equity out, maybe cash it out and buy another rental property? We can help you in those, because we are also investors like you. As a realty broker, I can identify investment opportunity. I can help you see the numbers. I can actually help you on the mortgage side to pull any cash you need to move around between properties, so you can have the big picture and have a successful business.
That's
So
fascinating, Frank. The best part
Thank
I
you
liked
very
was
much.
taking off 7 to 13 years of a 30-year
problem.
mortgage loan. It's fascinating. Last week, I had the pleasure of interviewing Miss America 2014. Today,
I'm not as good looking as her, but I hope the information I supplied is equal.
Today we are talking about real estate, and next week we are going to be talking to a movie star who is from Houston, Texas. Ladies and gentlemen, you have been watching the Triple N Talk Show. My special guest has been Frank Jreij, and I am Dr. Nik Nikam, and we'll see you next week. Thanks for watching.
Thank you.